Risk is really uncertainty. It's not just the idea of are we going to do well or are we going to do badly, but to what extent will we do well or to what extent will we do badly. We always have some sort of a baseline level of expectation, an expected case, and it might be necessary to consider some scenarios and maybe weigh them based on their likelihood. For example, the experts in your company predict the following results and probabilities from a business project. There's the expected result, what I've labeled average in this case, an 8.5% return, and the experts in your company are fairly confident that this will happen. They've attached a 60% probability to that. But they also accept that results could be poor or even very poor, or that results could be good or even very good. In the very good range, the results that we get, the return might be as high as 16.25%, and if the returns are very, very poor, they might be only 0.75%. But the likelihood of those very good and very bad results are very, very small, only a 5% chance in each case. If we take the probability of something happening and the expected result of that something, we can multiply those together and take the products and sum them and get what the expected rate of return is going to be. So if I look at the purple numbers off to the side, that's the result of those computations. We've got our 0.75% return times the 5% probability. That gives us a product. And the rest of the probabilities and returns are laid out there as well. When we add those up, we get 8.35, which means that our weighted average return that we expect from this project would be 8.35%. Variation or volatility of results is really just another form of uncertainty. And for this, I want you to cast your memory back to your statistics class. Now, in this course, I'm not going to require you to compute standard deviation the long way around, but you need to have a conceptual idea of what it is and what it represents. Standard deviation, if we're looking at a normal distribution, is going to be kind of the spread of the results that we're going to see. If you're looking at the bottom of the chart that's on the screen, the average result or the mean is going to be right in the middle of that spread of information. And on either side of that, we're going to see results which will go in a certain amount outside of that. And we're going to split the expected spread into 6 equal parts, 3 above the average and 3 below the average. And we're going to call each of those parts a standard deviation. Now, it is much more likely for us to see results which are going to be close to the average than far away from the average. And so the curve kind of slopes down on either side. If you're calculating probability, what somebody is really doing is calculating what area is under a section of that curve. In other words, if you are within plus or minus 1 standard deviation of the average, you're going to be looking at about 2/3 of the data points. About 2/3 of the area under the curve is going to be within 1 standard deviation of that average, or 1 tick mark to the left and to the right of that average. If we go out to 2 tick marks, or 2 standard deviations of the average, we'd be looking at about 95% of the results. And if you're just looking at one of those tails, the very, very right-hand tail in between the 2nd and 3rd tick mark, or just in between the left-hand 2nd and left-hand 3rd tick mark, you'd be looking at only about 2.5% on either side. So there's much less probability of getting an extreme result than getting a result which is close to the average. And the smaller those standard deviations are, of course, the more likely it is that we're going to get a predictable result. The average might not change, but if the standard deviation is very, very large, we've got a lot more spread in our chart, and therefore a lot more variation or volatility in the results we might see. If the standard deviations are smaller, we've got a lot less spread. So even though the average might be the same, we might be seeing more or less volatility, or more or less uncertainty or risk coming out of a situation. And similarly, we might have something which has just as much volatility as another asset or another project, but we might see the average results are different for some reason. So we might see the same amount of volatility, but a different average. If we're going to think about risk and return, we might want to look at an example. So consider the following. How do the following assets compare to stock X? If stock X has a 12% expected rate of return and standard deviation of 5%, we'd be looking at returns between 17% and 7%, about 2/3 of the time. About 2/3 of the observations that we make on stock X would fall between 7% and 17%. Contrast that with stock A. Stock A has the same expected rate of return, 12%, but it has a larger standard deviation. It's going to be plus or minus 7%, 2/3 of the time. So 2/3 of the time when we observe stock A, we'd see returns that are between 19% and 5%. It might get higher, but it might also go lower, although it's going to have the same average result as stock X. When we're making a decision, we need to consider both of these issues. We need to consider risk and we need to consider return, and ultimately we need to choose one of them to focus on first. Investors are risk averse, and what this means is not that they avoid all risk, but that they avoid unnecessary risk. So when you're avoiding unnecessary risk, you're going to look at the return that you get and see, does that meet your needs for the amount of uncertainty that you're facing? And when you're finding something that gives you the return that you want, you're going to seek the smallest amount of risk or the smallest amount of uncertainty that you might face. If you're looking for an average return of 12%, would you choose stock X or would you choose stock A? If you're thinking properly about risk, you would have chosen stock X because it has a smaller standard deviation. In the long run, you'll still get the same result. You'll still get the average 12% return, but you'll have fewer ups and downs to deal with in the meantime. When we're looking at uncertainty, it's also necessary to kind of think about how much bang for our buck are we going to get. One of the measures of that is going to be the coefficient of variation. Now, the coefficient of variation gives you one number that you can look at and compare regardless of what the average return is going to be. This is both helpful and sometimes misleading. So if we were looking at the coefficient of variation for stock X, we'd take our 5% and divide it by 12%. We'd come up with a coefficient of variation of 0.4167. If we're looking at stock A, we'd take our 7% and divide it by our 12%, and we'd come up with a coefficient of variation of 0.5833. Given that circumstance, it's easy to see that we have a higher coefficient of variation, and we're getting less bang for our buck from stock A. We're getting more bang for our buck with the lower coefficient of variation. The issue of diversification is that we're going to take uncertainty and we're going to try to minimize that uncertainty by investing in a collection of assets. And we're going to look for an average return which is acceptable, but we're going to make sure that our ups and our downs kind of balance one another out, that when one stock is going up, another one might be going down, and when one stock is going down, another one will be going up. So we're going to wind up with a collection of assets called a portfolio, which is going to minimize the risk that we face. Now, we can't really get rid of all of our risk. We can't get rid of all risk because our economy is also going to drive the returns on these assets. In a good economy, most stocks will go up and some will still go down. In a bad economy, most stocks will go down, but some will go up. So there's going to be a certain amount of risk that we just face because of the economic system that we're in. But we can diversify away unnecessary risk. We can diversify away, for example, the risk of one particular company making a bad decision.